The end of a 9-day rally, 30 minutes until the start of the cash trade. I'm Matt Miller. Katie Greifeld is off. Sonali Basak is at the Milken Institute Conference in Beverly Hills. Bloomberg Open Interest starts right now. Coming up, President Trump says trade deals may come as soon as this week, but Hollywood had better watch out as he threatens to tax films shot abroad. And it's the end of an era for Berkshire. Warren Buffett hands the keys to Berkshire Hathaway and its $350 billion cash pile to Greg Abel. Plus, we are live at the Milken Institute Global Conference in Beverly Hills with Marc Rowan and Bill Ackman, and much more today on Open Interest. In terms of the stocks that we're watching this morning, Berkshire Hathaway is one of them, now down 3.3% after Warren Buffett said he will step down as CEO after 6 decades running the behemoth, returning 20% a year. In terms of Skechers, we see a massive jump here. It's going to go private in a deal with 3G Capital, and Netflix is down right now almost 5% as the Trump administration, I should say, plans a big tax on the industry. Films made abroad will face a 100% tariff. The president wrote on Truth Social last night that he will tariff movies coming to the U.S. that are produced in foreign countries. Let's discuss how this would work with Felix Gillette. He joins me here at the set. Felix, thanks very much for coming in this morning. Let me ask about this tax. How exactly would it work that the president wants to put a 100% tariff on films made abroad?
I mean, a lot more questions than answers at this point. Does this apply to Hollywood movies where part of the production is done overseas? Because at this point, every big movie does some shooting overseas, some post-production. Parts of the overall movie gets made there. So is that going to apply? Does this apply to TV shows that are made overseas? The streamers at this point have a lot of operations. Netflix in particular has done decades of work building operations in foreign markets, both to cater to audiences overseas, but also, Squid Games, shows like that from Korea come over and get consumed here. At this point, I think people are scrambling around trying to figure out how this would be implemented.
How did this come up? I mean, apparently Jon Voight was at the White House. The two of them may be screening the Clint Eastwood classic Escape from Alcatraz together. Is Trump angry that Hollywood doesn't have as much production as it once did? Yeah, this goes back a couple months when Trump first announced that he was going to have some Hollywood ambassadors, Jon Voight, Sylvester Stallone, Mel Gibson. And the issue was, Hollywood has seen employment drop in the entertainment industry. A lot of jobs have gone overseas as some of the production moves to places like Hungary, New Zealand, Canada, that have lower production costs on labor and also offer a lot of tax incentives. So, Jon Voight and his team were at Mar-a-Lago talking about all of this with Trump over the weekend, apparently. Our understanding was that they were going to propose some sort of federal incentives, tax incentives for moving some of those production, post-production filming operations back to the United States. Already there's, state incentives to do that. But, the idea was maybe offer some additional federal incentives. And then out of that, we get this announcement about the 100% tariff. All right, so they were screening at Mar-a-Lago. I'm sure they have a good movie. I'm sure they had a good there as well. Felix, thanks very much. We will, I'm sure, talk more about this with you. Felix Gillette writes about Hollywood for Bloomberg. Outside of Tinseltown, a potential merger between oil supergiants Shell and BP could reshape the energy totem pole. Bloomberg was first to report that Shell is discussing a possible takeover of BP, and we're going to discuss now with Alix Steele. Alix, what do we know about this potential? It would be a big deal.
Huge deal. Suffice to say that it would be weird if Shell was not considering this in some form or another. Now, I had asked the CEO of Shell this exact question, and he's like, we're not thinking about it, we're not going to talk about it, but you got to be thinking about it, in part because the synergies would be so huge because they both have operations, say, in the Gulf of Mexico, for example. So the synergies alone, you could argue, would be really worth it. Also, Shell sold its Permian assets to Conoco back in 2021. So they don't have any U.S. onshore assets that relates to shale. So BP could be a big pickup for them on that. And even, say, refining operations, even if you're looking at say, gas stations and any sort of distribution stations, that would be huge for them as well.
I want to know why OPEC continues to raise production numbers, especially when we see Brent crude at $60, right? WTI below it. Torsten Slok reporting that that's less than the break-even costs for U.S. producers. So what's going on?
Twofold. So it took up from the Dallas Fed, and if you want to drill profitable wells, you cannot really drill them around these levels. For even operating expenses, that's into the 40s for some of the wells. Now, it's a couple-fold. One, if you look at the forward curve, you're still seeing backwardation. It just means that prices right now today are more expensive than prices, say, in a year. So you're still seeing a little, and that usually says that there's some demand strength. One, economic data still been pretty okay, so we haven't seen that fall off a cliff. And then three, it's cheaters. So Kazakhstan and Iraq have been pumping above what they were supposed to under this agreement, also the UAE. So if you're Saudis, you're like, why am I going to keep subsidizing their output at the expense of mine? And that's really the stressor. Now, some reports like RBC, Halima Croft, said that the Kazakhstan government said that there's no indication that they've been asked to cut oil output. Mike Wirth of Chevron told me the same thing on Friday. So that also might have moved the needle a little bit to be like, all right, guys, you're not even talking about it. Here we go.
All right, Alix Steele anchors the close for us, but also obviously covers the oil patch very closely, so I appreciate your time. I want to switch gears now to Omaha. Warren Buffett surprising the world by announcing he will step down from his CEO role at only 94 years old. He's only been running this company for 60 years. The news even came as a surprise to Greg Abel, his successor. For more, let's bring in Matthew Palazola of Bloomberg Intelligence, who was at the meeting, has flown back to New York to talk to us about it. And I guess you weren't blown away, right? Because he's got to step down sometime.
Yeah, I mean, I would say this. The meeting, it was towards the end. I was up since 4 o'clock in the morning. I was getting tired. I was looking at my watch. I said, oh, there's 5 minutes left. And then Buffett said, there's 5 minutes left. I have to make this announcement. So the way he made it was a little surprising. Like you said, Greg Abel didn't even know, but it coming was not a big surprise.
What does this mean? I mean, it almost seems like Buffett has prepared for this. You know, he's sold off so much into this downturn. He looks like a genius. He's raised a massive cash pile, and he's like handing Greg Abel a clean slate.
Yeah, well, so he is a genius, right? Yeah. You know, it was funny. He came up at the meeting where there was this thought that perhaps he was not making moves or doing things, like you said, to kind of clear the slate for Greg. And he said, no, I'm not. I didn't clear the slate for Greg. I just wanted, I reacted to what was happening. So, you know, the table is set. I think it is a great position for Greg to be in going forward.
All right, Matt, thanks so much for covering this. Matthew Palazola writes for Bloomberg Intelligence. We will be covering more on Buffett in just a few minutes. Right now, on Open Interest, we're going to show you what our extensive coverage of the Milken Institute Global Conference in Beverly Hills will look like. Sonali Basak is there, and we go to her now. Sonali, who do you have lined up for today?
It's interesting, Matt, that you started with Berkshire Hathaway because Buffett does loom large in Los Angeles because, of course, there are a lot of lookalikes. There are people who are building baby Berkshires. That includes Marc Rowan, who's going to be joining us in just about a half hour's time. Of course, Apollo has really adopted the Berkshire model in a lot of ways. Tomorrow, we have an exclusive interview with Todd Boehly of Eldridge. We'll be figuring out his plans for that as well. Later in this hour, we'll also be speaking to Paul Taubman. It's interesting. If you look this morning, we have a bit of a merger Monday on our hands. Let's see how far it could come back. Of course, we'll be beating the drum down to Scott Bessent, the Treasury Secretary, who will be speaking here at Milken. We will get you a readout. Stick with us. This is Bloomberg Open Interest.
Let's get to high interest now. We'll look at what's making headlines around the world. Israel's security cabinet voted to intensify military operations in Gaza and call up tens of thousands of extra reservists. The cabinet also decided on a means of distributing aid in Gaza, with non-Israeli private companies set to handle that aid. The decision comes a week before President Trump visits the Gulf. Trump pushed Israeli Prime Minister Benjamin Netanyahu to get more food and medicine into Gaza. And about 10 potential borrowers are looking to raise fresh capital in the U.S. investment-grade primary market today. That's according to an informal survey of underwriters who declined to name those firms. Over $38 billion was sold last week, and issuers are expected to keep selling fresh debt into the primary market, with $35 billion to $40 billion projected over the next 5 days. More corporate participation is expected this week compared with last, as companies break free from their earnings blackout periods. And President Trump says he has ordered the reopening of Alcatraz as a prison to house America's most ruthless and violent offenders. His Truth Social post didn't disclose an expected timeline for the reopening. Alcatraz, of course, sits on an island in San Francisco Bay. It was closed as a federal prison in 1963 after just 29 years of operation because it was too expensive to continue. The storied prison once housed Al Capone and George Machine Gun Kelly. And getting back to one of the top headlines of the morning, Berkshire Hathaway named Greg Abel the company's next CEO as of January 1st next year. For more, we're joined by Cathy Seifert, CFRA analyst and senior vice president. She has a hold on the shares and a price target of $535. So, Cathy, I wonder what you think of this. Not a surprise, right? It even looks as if Buffett has prepared the company for a successor.
It wasn't a surprise, although, the way it was communicated was a little bit of a surprise, especially to Greg. That was interesting. But, the two heir apparents were set up a number of years ago, with Greg getting the nod as being Buffett's heir apparent. So he's had a number of years to prepare for this. I still think there's going to be a period of adjustment. And I think the important thing for investors is calculating or figuring out what happens to the Buffett premium in the shares. And I think that's where we see some of the pressure this morning, is as investors weigh the implications for a post-Buffett Berkshire Hathaway.
What is that Buffett premium, Cathy? I mean, you look at some companies. I think right now Tesla is probably the best example, with a market cap of almost $1 trillion. And obviously it's a small car maker. Is Berkshire Hathaway the same kind of thing, where because they have a superstar CEO, they get a huge premium in terms of their market cap?
I think he has become a superstar, but I think it's because Berkshire had a CEO who was acknowledged to be, a top tier investor. And I think that's the premium embedded in the shares. And with him gone, investors are going to have to decide what kind of a premium does the company, is the company afforded? I mean, they do have a very strong balance sheet. There is a lot of cash on the books, but there is still a Buffett premium that I believe is going to have to be extracted from the shares. And I do see they're set to open lower this morning. I think in the very near term, there could be some pressure on the shares. And then as the year progresses, there may be a little volatility as investors come to get more comfortable with Greg Abel, as they look to see what potential changes he may make or not make at the company.
I mean, over his tenure, he's returned, Warren Buffett with Berkshire, an annual 20%. That's double the S&P. Why is this just a hold for you? Don't you want to own this for the rest of your life?
I had it as a buy last year and took some profits when the stock had run up and when revenues had slowed. Revenue growth last year was under 3%. They reported, lost in all this was their first quarter results. And, on a fundamental basis right now, the shares to me look fairly valued. Obviously, if there's a pullback, I'll reconsider that. There are a number of, I believe Berkshire at this point is at an inflection point from a number of perspectives, not just managerial. I think a number of their businesses are at an inflection point, sort of echoing where the economy is at an inflection point. So I think this could be a transitional year more than just from a managerial perspective. So I think it makes sense right now to be a little cautious on the shares. Yeah, I mean, longer term, it's a great stock. In the near term, there are a couple of headwinds I'd be a little concerned about. Not overly concerned, but I think it merits a little caution right now.
You know, Warren Buffett looked very smart coming into this year, selling off stock and raising a ton of cash as the market, came crashing down. Obviously, we've had an incredible run over the past 9 days, but is that just part of his genius? Did he get lucky? The timing looks pretty amazing.
Let's give him the credit where credit is due, and he did a smart move, and in many respects, I realize he said he's not setting things up for Greg, but he did sort of get his ducks in a row, got his house in order, however you want to, express that. Greg is inheriting a company that's in a good position, but does have some challenges. And, there is the cash hoard at Berkshire that people are looking to see how that will be deployed. I would also caution investors that entire cash hoard is not going to be deployed. A lot of that is also a reserve to pay insurance claims. But even if we assume that Berkshire has, $100 billion of dry powder, I think investors are going to be watching closely to see what kind of moves Greg may make.
Do you see anything, Cathy, that you think it would be smart to spend that money on, or do you think they should redistribute that back to shareholders?
Well, you bring up an interesting point, because I also think that there may be a cohort of investors in Berkshire that may start agitating for the company to pay a regular dividend. And I don't think that that's an outrageous request. And so I think, add that to the list of things that we may see change at Berkshire. Now, it may not change this year. It may not change until Buffett is no longer at the helm. But that is one thing that I do anticipate there may be pressure on the firm to consider.
Cathy, great to get some time with you. Hope we talk to you again soon. CFRA's Cathy Seifert talking to us about Berkshire Hathaway. Coming up, we begin the trading day with Threadneedle's Ann Berry. We'll ask her if she thinks now is a good time to get out. This is Bloomberg Open Interest. Looking at the S&P 500 over 9 days, we had more than here you can see 7.5% gain. It was an incredible rally that took us back to levels we haven't seen since Liberation Day, when we heard about the tariffs that shocked the world. Here at the desk with me is Threadneedle Ventures founder Ann Berry. And Ann, that was the climb after the huge drop that had everyone just in a panic, right? And I'm wondering if those people who were panicking because they held on to stocks knowing that Trump was going to do this, but not to that extent, is this now a time for them to get out while they still can?
Sell the rip is the
Yes.
question. I don't think so, and here's the reason. I'm a long-term believer in the U.S. equity market. But I don't really understand why we're at this particular moment at the level where we are at. To be honest, Matt, you and I were talking about it right before we went live. The fact that we're now at a level that's above where we were pre-Liberation Day, despite the fact the macro outlook is so much more uncertain, is baffling to me. I do think where the market is at is hopeful that this will resolve itself in a way that we saw the 2017 tariff regime level out, in a way that, quite frankly, there was bipartisan tacit agreement that something needed to be done with respect to the US's trade position. And I think the hope is that tariffs land in a somewhat sensible place, and then we have the halo of deregulation and tax cuts on the horizon. So I wouldn't sell in case it gets to a sensible position, but I do not understand why valuation right now is higher than it was.
So here's my concern with, first of all, tax cuts. Really? I mean, we're just going to get an extension of the tax policy that we've had. So you and me, we're not going to feel like we got a tax cut, right?
Well, I think there are some other tax policies that President Trump has talked about. He's talked about, in some cases, having no income tax at all, right, for certain folks, for example, below the $200,000 a year level. He's talked about trying to bring in more tax incentives for families. So, yes, it's the extension of what has been, but I think there are some other places. Also, he's not given up on the idea of lowering corporate taxes, right? Even lower. So I think that's something that's still hanging out there.
And they already don't pay taxes, right? The U.S. government gets like less than $500 billion from corporations. In terms of deregulation, that's also where a lot of people were very hopeful and I think have been to some extent burned. We haven't seen a huge wave of M&A as we thought we were going to.
Well, we haven't seen M&A yet, but I don't think that's because the belief is that deregulation isn't going to happen. So we've seen, for example, deep sea drilling, like deep sea mining, for example, is something that has come back on in. I don't think we have seen yet the end of where President Trump decides to go when it comes to financial regulation. Look at what happened at the Consumer Finance Bureau, right? So I think things have been quietly happening that haven't had the headlines because of the tariff noise, and I don't think we're done yet. So I wouldn't give up on deregulation yet.
All right, we're going to keep you with us over the open. We'll see if we lose at the beginning of this session. It does look like the 9-day rally is over, but futures are only down. You can see Dow futures down 260 points, S&P futures down about 0.8%. In terms of the other interesting moves, I go on the Bloomberg terminal and type GLCO GO a lot lately because that shows you global commodity prices. And we've seen a real drop in oil that I think is absolutely fascinating. NYMEX crude down to $57.35. Brent crude off down to $60.43. This after OPEC Plus said it was going to raise production again on Saturday. And that's what's I think President Trump hopes is going to bring gas prices down. He's cited a price at the pump of $1.98. I'm still seeing $4 in Westchester, but, you know, it's not West Palm Beach. We're going to get the opening bell up next here in New York City as we bring you coverage also from the Milken Global Institute in Beverly Hills. This is Open Interest. We are looking at futures down at the end of a 9-day rally. We're moments away from the start of trading. I'm Matt Miller. This is Open Interest. You can see we're off about 0.8% on S&P futures as some of the big tech stocks that rebounded so heartily. It looks like investors may be taking profits there to some extent. Also, President Trump has said he's not going to speak. He's not planning on speaking with Xi Jinping this week. NASDAQ futures are down 0.9%. You hear the opening bell in the New York Stock Exchange. Vesta ringing the opening bell. They're a group of happy men there, up 10% year to date. So they're actually making money in this market. You can see Morningstar ringing the opening bell on the NASDAQ, a service that I think a lot of us use every day. So great to see them there. In terms of the stocks that we're watching, Berkshire Hathaway is a huge one. Obviously, more than $1 trillion company, moving a little bit lower today after Warren Buffett's decision to step down as CEO. It has been 60 years. You know, it's time for the guy to rest a little bit, although I'm sure he won't. Skechers is going to go private, an $8 billion deal with 3G Capital, and the shares are up 25%. Netflix, though, down more than 3% in the early cash trades as the Trump administration says it plans to tariff the film industry. So let's get back to Threadneedle Ventures founder Ann Berry. She's still here and has thoughts on Netflix. And what an interesting move by the president. I guess he was hanging out with Jon Voight. Maybe he'd been thinking about this for a long time because people make films a lot more often now in foreign locations. A company like Netflix goes to South Korea. They go to Germany. They go to Spain, right? Instead of doing it in Hollywood. How does this affect them?
Well, I think it affects their near-term pipeline, right? As they think about their cost of production, that's going to have an immediate-term impact. But Matt, Netflix, when you take a big step back, is fascinating to me. And I've been long on it for a long time. It's been a terrific run-up. When I think about this particular environment and a consumer that's feeling squeezed and uncertain, I put Netflix in the bucket of what I now call the new affordable luxury. I think we're going to see strength in Netflix subscriptions. I think we're going to see strength in Netflix advertising dollars because it's one of the platforms I think that big ad spenders still want to go to. So I think this is a concern. I think this still falls in the bucket of a negotiation tool. I wouldn't be surprised if some of these sort of film credit and film cost issues disappear over time. So I'm still bullish on Netflix.
All right, so that's Netflix. In terms of your affordable luxury theme, what else is in that basket? Because I get that, right? You're only spending $15 or $20 a month. I don't know how much Netflix costs these days, but obviously I'm buying it too. And it's less expensive than going to the actual theater. What are the other affordable luxuries you're looking at?
I put Spotify in that bucket too, and actually it's trading at a cheaper valuation than Netflix. Certain elements of beauty has been under some stress over the last year. But areas like premium skincare are still doing very well. Blue Mercury's moving to, I'm on the board of Rodan and Fields. Ulta's pulled them in. Evidence that dermatologically backed brands are still something that people are willing to spend on because as they cut back, for example, on cheaper cosmetics, they want to go in on efficacious. That, I think, continues. L'Oreal, as a result, from a public stock perspective, I think is better positioned than others. The last thing I would say, Matt, and you and I have talked about this before, I think the cruise sector is undervalued. I think post-COVID consumers are going to fight tooth and nail to keep some budget allocation to travel, and I think the value proposition that delivers it are people like Royal Caribbean and Carnival Cruises, an affordable travel luxury or vacation luxury.
So the idea is that because these are usually package deals and it's less expensive than booking your own flight, your own hotel, your own activities, a babysitter, etc., they're going to the all-in-one Royal Caribbean or I don't know the other cruise line.
Yeah, so Norwegian or Carnival. And it's interesting, when you unpack the actual value that's being delivered to the consumer, the rough estimate is the land-based equivalent is about 20% more expensive than that cruise package when you put in travel and food. So if you're a consumer thinking about how to allocate your budget, again, post-COVID, I think people are saying, I do not want to be not traveling again. Where do I go? I think cruises are a good value proposition. You look at something like a Royal Caribbean trading at a high single-digit EBITDA multiple, same with Carnival. It's pretty good value, to your point, in what's been a toppy market despite the noise.
But the bottom line is you're still looking at a downturn. You're looking at a consumer that's weaker. You're looking at lower CEO confidence. So these are consumers holding on to what they can or even trading down a little bit.
Trading down, and we've seen Walmart be the beneficiary of that. But if you look back to post-2008, for example, this affordable luxury theme came up then, and we saw people still doing things like buying certain cosmetics. We saw people doing things like buying Starbucks, right? If you actually think about it, coffee out of the home should be the most discretionary item. Why are you dropping $5 on a coffee when you're feeling stressed? And you actually saw consumer psychology and behavior. Folks were saying, in a moment where I am feeling compressed in terms of my choices, compressed in terms of income, I want to find just those small things that are small enough share of wallet that they spark enough joy that I'm going to do it anyway.
$5 a day.
Back in the day. Back in the day. Do you remember that? Coffee
$25 a week, $100 a month. I mean, you could really save a lot of money that way.
It's really discretionary, but people were still doing it.
Ann Berry, great to have you with us. Thank you so much for joining us. Ann Berry there of Threadneedle Ventures, talking to us about the affordable luxuries that the consumer may try and hold on to in this economy. Let's talk about Merger Monday. Shell is looking into the possibility of acquiring British Petroleum, BP, and what could be a mega deal that reshapes big oil. Bloomberg's Liana Baker covers deals for us here at Bloomberg and joins us to discuss just one of the many deals that we could be talking about today, but this would be a big one.
So this is big news, but if you read our report, it's pretty nuanced. So Shell is speaking to their advisors, their investment bankers and others to see if now's the right time to make a move on BP. BP, as you know, has been the target of a big activist investor, Elliott Management, and the value has just really not been good. It's worth half of what Shell is worth. So Shell is trying to figure out, is now the right time opportunistically to make a move? They haven't made a move yet.
Would they face real regulatory pushback? I mean, I imagine this is the kind of thing, if not U.S. regulators, then European regulators or U.K. regulators are fighting back hard against.
They would definitely face scrutiny all over the world, but from what I've read from research analysts, there is a good fit between some of the geographies that these companies are in where there wouldn't be that much overlap. We would look at, the Gulf of America, Gulf of Mexico, for example. That's one area to look for, but this would not sail through regulators if it got announced.
I personally worry about the gas, right? Because I'm a sucker for marketing, and Shell has the whole Ferrari Formula One thing. So I can't buy gas anywhere else, but I guess I would would be able to in this case. In the same area, Sunoco and Parkland, what's the story with that deal?
You mentioned gas. This is an interesting one because there's also an activist investor in Parkland, which is in Canada, my home country. So this is a cross-border deal. And Parkland, because they had an activist, they had to explore options with investment banks. And as part of a strategic review, this is clearly the option that they took. And this will be, a big move for gas station consolidation.
What are the other, what's the update in terms of M&A in general? Because we were just talking with Ann Berry about the fact that we really haven't seen a wave of M&A, the likes of which we were expecting with Trump's deregulation.
So you mentioned it's a merger Monday, and we did see 3G doing their first deal in many years to buy Skechers, a brand that everyone knows. That's a cross-border deal. We also had the gas station deal you mentioned, Sunoco, Parkland, cross-border, U.S., Canada. So we are seeing these spurts, these areas of M&A. If you know where to look, there is deal-making happening.
But it isn't to the level that maybe we would have expected. We're not going to best last year's level at this time.
A Shell BP deal would provide that jolt to the M&A markets. That would be a mega deal, and we're tracking to see if we could see other big moves like that, because in times of dislocation, that could be a time to pounce.
All right, Liana, thanks so much for giving us an update. Liana Baker runs our M&A coverage for us here at Bloomberg. I want to take a look at GLCO Go on the Bloomberg terminal again very quickly, just to show you where a lot of my focus is on the oil patch and why. So you can see here at the top, WTI crude coming down another 1.5% to 57.46 a barrel. So in the 50s there, and Brent crude isn't much further away, down 1.25% today at $60.53. This the global benchmark, as OPEC Plus says it's going to raise production again in a Saturday meeting, and that is bringing oil down, and I think President Trump hopes as well gas prices down. The problem is that at these levels, you get to below the price it makes sense to produce at for a lot of Texas. The Dallas Fed came out with something that Torsten Slok highlighted in his daily Spark note. We also continue to see the dollar fall. So the U.S. dollar coming down again today, especially against the Taiwan dollars. Exporters there rush to swap currencies. But the U.S. dollar now back to levels we haven't seen since September. And here you see what we're looking at in terms of the cash trade. S&P 500 down 0.75% to 56.45 after a 9-day run, the longest run we've seen in 21 years. The U.S. 10-year yield right now at 432.97, so call it 433. There's the dollar, the Bloomberg Dollar Index, which I think is a much better trade-weighted way to look at the U.S. currency than the DXY that Wall Street has relied upon for decades. 12.19 on the BBDXY, and then NYMEX crude down 1.5% to $57.43. Coming up, we're going to head to Beverly Hills for the Milken Institute Global Conference. We're going to be spending a lot of time there over the next couple of days. We kick it off today with Apollo CEO and co-founder Marc Rowan. He joins our very own Sonali Basak next out of Beverly Hills. This is Bloomberg Open Interest.
And we welcome our TV and radio audiences. I'm Sonali Basak at the Milken Institute Global Conference in Beverly Hills. And joining me now, Apollo CEO and co-founder Marc Rowan. And what a time to be speaking with you.
Just a few things going on.
A few things going on, but a lot today alone. We have the Treasury Secretary speaking at 8 o'clock here Pacific time. We had Elon Musk speaking last night, and the President of the United States changing his tune on tariffs. Where do you think the end game is, given that the tariff talk is taking up so much of the discussion here?
Look, what the administration wants to do, in my opinion, is not wrong. We are the freest trading country in the world and have been since the end of World War II. It is not clear to me that we have to be, or that we should allow allies and strategic competitors to inhibit our access to their markets. We can take issue with how it's being done and the uncertainty it's creating, but the president and the administration start with a really strong hand. Low unemployment, good job growth, massive capital investment over the last 4 years and continuing in the U.S. So now is actually a good time, but we have uncertainty. And in the face of uncertainty, people do not make new investments, they do not hire, they do not make moves. We likely will cause 2 quarters of negative growth if we, in fact, don't resolve the uncertainty. So until we have resolution of what the rules of the game are, it's going to be slow.
A lot of people talk about the potential for a recession, but little are people talking about the severity that could exist in the potential for a recession.
Look, now we're talking about forecasts and projections. In our firm, when we were raising rates 300 and 400 basis points, we talked about a non-recession recession, which is a correction in asset prices, but not necessarily in labor. We kind of see the same thing happening again. It's not to say we won't have some fallout and some adjustment, but we're starting from a place of 4% unemployment, good job growth. We are building infrastructure, we're building semiconductor plants, we're absorbing massive amounts of foreign direct investment. Like it or not, we're building Inflation Reduction Act factories. And now the president is channeling capital from around the world to come back here. Some days I wake up and worry about capital. Most days I wake up and worry about where will we get all the people to do this.
Now, you mentioned that you agree with what he's doing, but maybe not how in all the ways. To the extent that you think that this should be done differently, to the extent that you don't like the method of the change, what needs to change?
Look, this is now the toughest job in the world is now Scott Bessent. As I said, we want this administration to succeed. Every American should want this administration to succeed. So how I would do it is not really relevant. I will point out the following. U.S. and Mexico together should be the driving economic force in the world for the next 50 years. We have not been able to get there, despite 2 or 3 rounds of massive free trade agreements. The issues that separate us from Mexico are not existential to Mexico. As one leading Mexican industrialist said to me, if it takes tariffs to make Mexico great again, so be it. Inside of Mexico, there's a need for change. Imagine coming to the world with Mexico and Canada resolved first, and then taking people piece by piece, or country by country. We would just be in a much stronger position to do what we need to do to reset the terms of trade.
But in the meantime, you had mentioned it as well, that people are on hold. Businesses are on hold. A lot of businesses are at risk of layoffs if this continues. How long can this uncertainty continue without causing much greater damage?
Look, we're going to have uncertainty. We have uncertainty already. Until we see critical mass of trading partners agree to ongoing new economic relationships, we're going to have uncertainty.
But that could take years, couldn't it?
That could take years. I don't think the administration will allow it to take years. Clearly, what they are trying to do is to create positive momentum by getting country after country to agree to new terms of trade. If that happens, this could be very short-lived. If it doesn't happen, uncertainty could continue for a period of time. But we also have to take into account short-term and long-term. Uncertainty will eventually resolve itself. Longer term, the way we've done this, we have done damage to the U.S. brand. The brand for stability, for predictability, for regularity. That will eventually have some cost to us. Right now, it does not. What I've said is I see us moving from what was hyper-exceptionalism to merely exceptional, because I don't think there are good alternatives to the U.S. today, but that can change over time.
Let's talk more about the U.S. brand for a moment, because you have businesses across the globe, from Europe to Japan. Now, what are they saying? What are your investors in different regions saying about their willingness to put money into U.S. capital markets? Your deputy, John Zito, had written a letter to investors talking about the risk to the U.S. brand as well, the risk to U.S. capital markets.
Right.
Are you seeing any of that?
We will see it, but we're not seeing it yet. But think about the U.S. is still 60+% of all the capital raised in the world. We are in the absolute best position from a capital formation point of view. No one has what we have. That does not mean they will not want it over time. Everything that we want to do here, build infrastructure, next generation manufacturing, add energy, defense, next generation data and power. Europe wants to do exactly the same thing, but lacks any real source of long-term capital. In the Draghi report, Mario Draghi lays out what Europe needs to do to be competitive. And most of the report is focused on revisions to capital formation. Will Europe do that? I don't know. I think what John Zito points out in his letter, that they have the best chance relative to the U.S. to create this kind of positive momentum.
So then there's the question of what you do in this uncertainty. Now, recently you told investors just last week that you're willing to sit things out, you're willing to reduce leverage. However, you believe that you are one of the largest active buyers of assets post-Liberation Day. That is $25 billion in April alone. What are you buying?
So let's start with, I talk to investors and I ask 3 questions. Are prices low? No, I do not believe prices are low. They are lower, but we're still talking about an average PE as a reference in the mid-20s versus 16 over time. Are rates likely to plummet? I don't think so, and our firm does not think so. Most of what we're doing is inflationary. Third, do we have heightened geopolitical risk? Listen to our conversation. There's heightened geopolitical risk. What do you want to do if those 3 things are true? I think you want to reduce risk. In credit, we're going up the capital structure, senior secured, investment grade, trying to reduce risk. We're not trying to make money by being a good credit selector in a volatile market. And in the equity market, moving from things that are growthy and things that are venture-y to things that are cash flow based and more hybrid in their outcome. So what did we do in April? We bought mostly investment grade. Ironically, mostly in the public markets. I think we will see this interesting dynamic take place. We have a perception that what's public is safe and what's private is risky. But what if we're wrong? What if public is safe and risky and private is safe and risky? In private, most people are set up to hold things for the long term. In public, we have this belief that we can sell something every day. In equities, that is true. In fixed income, it is not true in the best of times. It is certainly not true under stress. It takes 5 days today to sell an investment-grade corporate bond. We should expect in every risk-off moment, public credit to trade poorly.
So what about the future? If you think that we saw some moments of market, let's say seizure, right? You did see full moments where there were weeks at a time where the new issuance market was closed. Do you worry about liquidity into the year, given the way things are going? And do you think that the Fed would need to step in?
So I worry about liquidity, but in a different way than you're asking it. I think there's plenty of money in the world. If we use that as a proxy for liquidity, could we have tough treasury auctions around political events? Absolutely. I don't think that is actually fundamental. What I worry about, and the biggest buildup of risk I see in the world, is we are brought up with an expectation of being able to trade everything every day. Everything is daily liquid. Your ETFs, your open-ended mutual funds, and so on and so on. In the equity markets, it's actually liquid. In the credit markets, it's not actually liquid. We just don't know that yet. We've seen it in the UK in something called LDI, where people thought they could sell something, and it turned out they couldn't. We're going to see that. We saw it in the run-up to COVID. We saw a little blip in the market over the past few weeks, which is why we ended up buying. But again, this notion that everything that's daily liquid is somehow safe is just a notion. It's just not true.
So I want to go back to something you were saying before, that this environment that we're facing could be very inflationary, right? If you believe that we are facing an inflationary environment, what do you make of President Trump's bid to try to get the Fed to lower interest rates at this juncture? Do you think it's possible?
Good news. I don't have that job. It's not even in the realm of possibility for me to do. Look, we are moving things from low-cost labor countries to higher-cost labor countries, particularly to the U.S. There are strategic reasons to want to do that, but we can't deny that that is inflationary in some ways. We are not relying on a global trading system to the extent we have previously. That is inflationary in some ways. We have a tight labor supply, 4% unemployment. We had good job numbers. We have no legal immigration. That is inflationary in some ways. Yes, are there countervailing measures? Energy prices are lower at the moment. Technology will eventually introduce savings. The key word being eventually. At the moment, the policies we're following have a risk of being more inflationary than otherwise, which generally will lead to higher long-term rates, even if short-term rates come down.
Mark, we thank you.
Macro.
I know, it's the macro world that we're living in, and we will be watching you closely because we are waiting for that fat pitch investment. Marc Rowan of Apollo, of course, joining us here at the Milken Institute.
All right, Sonali, thanks very much. Fantastic interview there with Marc Rowan of Apollo. Really interesting summary at the end from Marc there that they are moving their labor from low-cost countries to higher-cost countries, and that will be inflationary, even as oil prices come down, even as technology starts to introduce savings or eventually introduces savings. Coming up in the next hour, we have a lot more from Milken. We have Pershing Square's Bill Ackman. Shanali wrangling interviews out there. She's got Mike Gitlin, I should say, of Capital Group, as well as Paul Taubman of PJT Partners. So she's been working on this very hard, and she's going to knock it out of the park. In terms of what we've got going on in the markets today, we had a 9-day rally. It was the longest winning streak since 2004. That couldn't continue. Could it? Right now we're down 0.75% on the S&P 500, back at 56.44, back at April 2nd levels. We could see a swing during this day. Stranger things have happened. I'm Matt Miller. This is Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Katie Greifeld is off. Shanali Bastick is at the Milken Institute Global Conference in Beverly Hills. We're going to catch up with her shortly. I want to quickly take a look at the markets because we are down right now about 0.7% on the S&P 500. You can see the 10-year yield rising a point. We have the 2-year, the 3-year, the 5-year coming down, so the curve steepening a little bit there. The dollar index coming down to 12.20, and crude well under $60 at 57.46. We have breaking economic data with ISM services better than expected. Let's get straight over to Michael McKee for a look at what we got. Mike?
Bit of a surprise. The ISM services number comes in at 51.6. Last month it was 50.8, and the forecast was for 50.2, so much better than expected. Going under the hood, we're looking at numbers that are also better than perhaps expected. When you look at the prices paid index, 65.1. That's higher, not better than expected, but it does tell you something about where we are with all this. But the new orders index rises to 52.3 from 50.4, and that tells you there's still some momentum out there. Employment 49 from 46.2, so it's contraction, but not terrible. Inventories 53.4 from 50.3. We know companies have been bringing in a lot of stuff, so that may account for that. But new export orders, 48.6 from 45.8, imports 44.3 from 52.6. So built up inventories and stopped importing as much. But, Matt, the new orders are still relatively strong, and we end up with a stronger than expected headline.
Yeah, very interesting stuff. And you've seen, I mean, we're still seeing a steepening of the curve. I'm just looking at the shorter end there. We had seen the 2-year, the 3-year, the 5-year all yields all coming down. Now they're rising a little bit, although the end of the curve is rising even more. Why do you think the market moves on these so much?
It's a knee-jerk reaction because basically people are saying it's going to be harder for the Fed to cut interest rates. So they push back on the idea of interest rates going down quickly. This is still in the interregnum. We don't know what's going to happen with the tariffs, so these moves don't mean a whole lot. But that's, I think, the thinking on Wall Street is certainly nothing's going to happen on Wednesday, but probably not for a couple months at least.
Yeah, absolutely. Of course, we're going to still have full coverage of the Fed meeting.
I figured I should probably go.
You'll be down there. You can get Jerome Powell into more of the 80s and like early 90s dead, because he's been saying lately he's only a fan of 60s and 70s stuff. And of course, we had the Fed decides. Tom Keene back on television. We're all excited about that. Mike McKee, thank you very much. We are looking at the S&P now down only 0.5%. The Dow Jones Industrial Average getting closer and closer to unchanged. But right now, I want to head back over to the Milken Conference. Shanali Bastick is standing by there in Beverly Hills with another special guest. Shanali?
Yeah, thank you, Matt. I am standing by now with Bill Ackman. Of course, he's the CEO of Pershing Square, but also the new executive chair of Howard Hughes. Came in this morning with a $900 million deal. Of course, that brings your stake to more than $1 billion when you include all of your affiliates as well. Why? You said you're going to turn this into a diversified holding company. You said this is the intent to create a modern-day Berkshire Hathaway. How do you plan to make that happen?
Sure. Actually, our stake in the company is much larger. We talk about $1.2 billion. That's a $900 million investment that's being made by Ryan Israel, my CIO, myself, and other Pershing Square team members. And on top of that, our funds own a substantial stake in the company. So we're on a look-through basis, we'll own $1.2 billion. And our plan is to take this great company, which has been a real estate development company over its 14-year history, and transform it into a diversified holding company. That's the business plan. We're going to do that by buying great, really high-quality, durable growth companies.
Now, it's interesting, to the extent that you want this to be kind of the next Berkshire Hathaway, you know, we had some amazing news over the weekend here, historic really for Berkshire, Buffett stepping down as the CEO. Have you had any plans to reach out to Buffett himself to figure out how to do this?
So, first of all, I don't want to say we want to be the next Berkshire Hathaway. Warren Buffett's been an incredible sort of hero for me. I've learned an enormous amount watching the creation of Berkshire Hathaway over my career, and he's an aspiration. But Howard Hughes will be something different. We're starting out differently. Buffett started out with a business with not particularly attractive long-term prospects, that he acknowledged. In our case, we're starting out with a business that has very attractive long-term prospects. It's a wonderful business, but it's not a business that I would say Wall Street is assigned a real value to. But it's a very valuable platform. It's a business that's going to generate an enormous amount of cash over many decades. And what we're going to do is we're going to take the $900 million, and then over time, when and if excess cash is created at the real estate subsidiary, then we'll have even more flexibility to use that cash over time. And we've got a good track record investing in the highest quality growth companies in the world. We're going to do that on a much smaller scale as a controlling shareholder at Howard Hughes.
Now, you've mentioned also that insurance might be part of the future in a bigger way for this company. How do you plan to expand on that insurance arm? And to the extent that you would be willing to do M&A, what would that entail?
Sure. So obviously, Berkshire's had the benefit. Buffett's an amazing investor, but the enhancement to his selection of great companies and securities is that he's financed that not just with equity, but very low-cost leverage in the form of insurance float. That's something, obviously, that you learn when you follow Berkshire Hathaway. And interestingly, most other insurance companies are standalone public companies. Here you have an insurance company that's a major part of a diversified holding company, and that's given Buffett and Berkshire significant advantages in terms of increasing the flexibility of how that float can be invested. So that's a model that we're going to pursue. We're going to likely pursue it by recruiting a great CEO and a team and building a company, maybe from scratch, maybe from a very small scale. That's sort of part of the business plan.
Now, one big question I'm sure a lot of investors have for you is how are you going to ensure that the Howard Hughes business doesn't compete with Pershing Square, both in terms of investments as well as your time?
Sure. So Pershing Square's strategy, the strategy of the Pershing Square funds is to buy minority stakes in large cap and mega cap companies, in great businesses, in some cases that have lost their way, and we can be helpful in making them more successful, or in great businesses that for whatever reason the market is not assigning a proper value, or people responding to news unrelated to the business, and those stocks get cheap. But it's a minority investment strategy in very large companies. Howard Hughes, we're going to use Howard Hughes to acquire controlling interests, 100% interests in private companies, maybe some small cap public companies, much smaller scale, and controlling interest.
Now, what about the rest of Pershing Square as well? A lot of people still have a lot of questions. Do you plan to still raise money for a closed-end fund?
Sure. SEC doesn't like us to talk about potential future offerings, so I have to defer on that one.
So what about for Pershing Square overall? What's the long-term plan? There has been an IPO floated around, but do you still see yourself getting there, and over what kind of timeline?
So the long-term plan for Pershing Square is to build, one, to deliver great returns for our investors and our shareholders, and the shareholders of Howard Hughes. And of course that benefits Pershing Square the Pershing Square funds, because we have a major investment already in Howard Hughes that we look forward to making more valuable. So that's kind of our laser focus. I do want to make Pershing Square an entity that survives. We manage permanent capital, so it's important that the a manager that oversees that permanent capital becomes a perpetuity. And while Buffett is 94 and still incredibly active, if I want to compete with that track record over time, it's important that we set up an entity that can survive for the very long term. So I don't know exactly what form that will take. We did sell a minority interest in Pershing Square to a group of investors last year, and we set up an independent board of directors, and we really run Pershing Square, the management company today, almost as if it's a public company from a governance and other perspective.
Now, I want to talk about your portfolio as well here, because with this new company, you had mentioned small and medium-sized businesses. Of course, you're exposed to a large swath of the American economy through Pershing Square already. How are the tariffs impacting you today, and how do you think that impact will last 6 months, 12 months from now?
Sure. So first, we try to own businesses where no matter what's going on in the world, what we call extrinsic factors we can't control, whether those are commodity prices or tariffs, excuse me, or a pandemic, interest rate volatility, don't have a material effect on the business. So we look for what we call durable growth companies. And these are the kind of businesses we're going to try to find for Howard Hughes. They're very much insulated from things macro. Obviously, they do better. Every business does better in a positive growth environment, does worse in a weakening growth environment. But our companies today, other than Nike, I would say, have really not been directly affected by tariffs, although market prices move up and down based on uncertainty.
Does that not bother you, though?
No, it doesn't bother me. Look, the president has an objective here, right? It's critically important for the United States, strategically and defensively, for us to source certain key products in the United States, have them be manufactured here, whether those are pharmaceutical ingredients, or stuff we need to defend the country, to build weapons, AI, anything AI related, semiconductors, and so creating the incentive for those important high value manufacturing and other activities happening here, I think is critically important. For 80 years, beginning after World War II, the United States, helped save the world, and then helped save the world economically, and allowed for trade barriers to be built up over time. That's allowed Asia, countries in Asia, Europe, to Marshall Plan, et cetera, to recover. And then over time, those tariff barriers have remained, even as those countries have become very aggressive competitors of the United States. Think the Japanese auto industry and how it, has really dominated U.S. Auto industry over time. And it's time for those trade barriers to come down. And the president is using tariffs in a tactical way to address those trade barriers, which are not just tariffs, but there are other things that make it difficult for U.S. goods. The other issue he's trying to address is balance of trade, right? We still have balance of trade issue. Buffett actually talks about this long term as a problem, and he wants to incentivize companies to do business in the United States. Now, the way he goes about things, as we've seen from the president, is a bit of I would call it shock and awe, which tends to scare people. But ultimately, he's a deal maker. He likes to make deals, and I expect he I think did the right thing in pausing tariffs, reciprocal tariffs for 90 days, and I think that gives time to negotiate with our 18 largest countries. And I think the next step probably should be, I call it a 180-day pause, take down the China tariffs. That will give U.S. businesses that are actually under pressure. There are a lot of businesses, unlike the ones we own, that a tariff of 145% on goods they source from China can decimate the businesses, particularly small businesses that don't have the wherewithal to manage through this period of time. So I think we want to be economically our strongest when we're negotiating. And the president, pausing tariffs for 180 days on China sets up a very interesting dynamic where, puts us really in the driver's seat. Give me 1 second. It's an important point.
Of course.
So right now, because of the announcement, every business that sources in China, every U.S. company, et cetera, is relocating their supply chains out of China. That's not going to change, even if the tariffs go from 145% down to 10 or down to 20%. So once we pause, China is under enormous pressure to make China a good place to do business, to eliminate these kind of trade barriers, and I think enabling a very successful negotiation.
So you were among the first to advocate for that 90-day pause.
Yes.
Did you talk to anybody in the Trump administration or the president himself? And are you in talks with him about this 180-day pause? I saw you post about that online as well. So you are getting more vocal about this idea. Can it happen?
I think it can certainly happen. I heard Scott Bessent was here yesterday. He seemed very constructive on where negotiations are headed. So we shall see.
But more specifically, is he receptive to your idea?
I don't think it's a good idea for me to discuss relationships or conversations I have with people in the administration.
Well, fair enough. Do you think that there could be exemptions made? You mentioned small businesses. This is a part of the economy that is getting hard hit. You've said it yourself. How is this a Main Street strategy if small businesses are getting hit harder than the larger ones?
Sometimes you have to have some short-term pain to get a much better long-term outlook. But I think the president has made his points clear, and I do think it's important to kind of pause the China tariffs. That will take the pressure immediately off of kind of the smaller businesses, and it's not just affecting small business. Now, by the way, there are some positive effects from the China tariffs, which a number of U.S. manufacturers, many are doing very well because, of course, people are looking to source product in this country. To the extent something's made in China before, and there's someone you can source from in America, you're banging down the door to do business with them here. So there is a big boost to a meaningful number of small, medium-sized, and large businesses that manufacture in the U.S. But there is a negative effect on companies that don't have that flexibility or the nimbleness to move their supply chains quickly. That's what I'd like to see avoided.
Do you think that this can be done while avoiding a recession? Do you think that a recession is a foregone conclusion at this point?
I don't. I don't think a recession is a foregone conclusion, and I think there are real reasons for optimism. I just don't want this turbulent period to carry on too long. I'd like to see deals get announced and progress made, and then I think people can start looking beyond the immediate 60 or 90 days.
You mentioned that even after that 60, 90, 180 days, that tariffs will still be higher, right?
I don't know what the ultimate outcome is, and it's not just tariffs. You got to look at the overall effect of the various trade barriers coming down, right? There are countries with low tariffs but still have enormous barriers to U.S. goods in their market. And so it could absolutely be a lot of reasons for optimism about the economy. So one, the tax bill. Yesterday, the Treasury Secretary said it could be signed on July 4th. That's a very pro-growth initiative. The deregulation process could be very pro-growth for the country. Inflation has really come down meaningfully. Energy prices, gas prices, egg prices, right? That's a very positive thing, for our economy and for the consumer. I think the only thing that we suffer from right now of substance economically is the inherent uncertainty about the tariff situation. I think the sooner that's resolved, the more the economy can move forward. And there's also reason for optimism kind of geopolitically. I think it's likely we'll have, I think the Ukraine-Russia war can get resolved this calendar year, and hopefully sooner rather than later. I think the Middle East the temperature can come way down once we resolve by negotiation or otherwise the Iranian situation. So I'm an optimist, and I've always been an optimist about our country.
So before I let you go also, I want to have you weigh in on what's happening between Harvard and the Trump administration as well, because this morning you had called for the resignation of Penny Pritzker from Harvard's board.
Yes.
Now, have you talked to her personally or any of the other board members?
So I spoke to her very early on in the midst of the events on campus after October 7th. I've only spoken to her once. And by the way, I don't know her well. I'm sure she's a lovely person. But at some point you have to have accountability for what's gone on at Harvard. And I've not seen any accountability at the governance level. The notion that she's still chairing the Harvard board and leading the charge here, I think is a big negative. And I think they've mismanaged the relationship with the administration in a way that's enormously economically costly to Harvard and funding at Harvard, and you need a new face at the top of just even to make a deal, right? And again, I go to the corporate. Harvard's the oldest corporation in America. Go to any other corporation, if they manage the last 18 months the way that they managed, there would be a new chair and there would be a new CEO in place. The new CEO is there, but he's more interim. But they've done nothing in terms of accountability at the board level.
Has the ship sailed for Harvard in terms of a potential negotiation with the administration?
No, and I would love to be helpful there. I care enormously about the institution. I want Harvard to succeed. I think the president has a number of very key issues that are critical. It's not just the issue of anti-Semitism and pro-Hamas issues on campus. He makes some very good points about bureaucratic waste at the institution. I believe that if taxpayers are funding a private institution like Harvard, particularly one that has a massive endowment, the university is a fiduciary for those funds, and if they're wasting money on overhead and bureaucracy that really is interfering or certainly not enhancing education, they should do something about it. Education is about being exposed to diverse views, and if university, as I've said, becomes a political advocacy organization, query whether it should be getting taxpayer support.
Bill, we thank you so much for joining us here on set. That is Bill Ackman, who, of course, is the CEO of Pershing Square, as well as the new executive chair of Howard Hughes, fresh off of a deal just this morning, Matt. Back to you.
All right, Sonali, fantastic interview. A lot of really interesting stuff there from Bill Ackman, saying that Nike is the only investment he has that's really affected by tariffs, and yet he isn't unhappy about them. He says you've got to have some pain sometimes to get the result that you want in the long run, although he does say he is in favor of a 180-day pause on tariffs as the next step. And, of course, we're in the middle of a 90-day pause right now. In terms of what's going on in the markets right now, let's take a look at what's going on with the S&P 500. We had better than expected ISM numbers, and as a result, the markets recovered to some extent, now only looking at a 0.5% drop on the S&P and the NASDAQ, had been almost 1 full percent. You can see the 10-year yield up now to 435. The dollar index holds at 1220, and NYMEX crude is below $57 a barrel at 56.80. Coming up, more from Milken with Mike Gitlin of Capital Group, as well as Paul Taubman of PJT Partners. This is Bloomberg Open Interest.
I'm Sonali Basak alongside Romaine Bostic at the Milken Institute Global Conference in Beverly Hills. And of course, we are joined now by Mike Gitlin, the CEO of Capital Group. And it's an interesting time to be investing in public markets. You're about to introduce your clients to private markets as well in a bigger way. What's most on your mind? Tariff is the talk of the day, but ultimately, is that what is concerning you the most as you try to navigate this year?
Yeah, what we're trying to do for our clients is think about long-term investing. Tariffs on everybody's mind. But for us, we're just trying to deliver them outcomes over the next 5-10 years. And I think there's a lot of noise in the marketplace today, a lot of uncertainty. People have to be very careful, though, not to touch their portfolios too much in the midst of all of this uncertainty. Focus on the long term, just deliver outcomes.
When you look at the uncertainty out there, Mike, do you see a chance that it could be tamped down, that the policy chaos in Washington and the reverberations through financial markets, are we anywhere near a peak in that?
Well, I think you're already seeing the markets calm down a little bit. I think we had tremendous activity with the tariffs in the first couple of months. You're starting to see people focus now on individual deals, seeing a little bit of a pathway towards a normal environment. I think we'll get there over the next few months, and I think the markets are telling us things are going to be just fine.
So, to the extent people are nervous, you were saying at the beginning, don't touch your portfolios too much. How much are clients calling you, asking you to make movements? Are people trying to rush to safety?
I think over time, through multiple crises over the last multiple decades, financial advisors have really trained their clients to be calm during these periods of time. The activity and the volume's been much lower than you think it would be. So I think that training of their clients for financial advisors, there's 285,000 financial advisors in this country. They're training their clients to say, let's just look for the long term and don't touch your portfolio. you might find some opportunities. So if the markets are down 10, 15% because of all of the uncertainty, you'll see people maybe invest for the long term then, but you're not seeing a tremendous amount of angst and saying, gosh, I better get out of the markets. You're just not seeing that.
What's the moment you're waiting for then to deploy more capital? If you think about the drawdowns we've already seen, they're fairly significant. Do you think that there's a bigger moment ahead that investors should be waiting for?
I'm not sure if there's a moment. One of our portfolio managers said it's a great time to invest in good companies at a lower price. And I think that's the right mindset. I don't think you can wait for a specific event or a specific moment. You just have to focus on, is this a good company? Do they have a good moat around their business? And is it cheaper today than it was before? Then you have an opportunity to invest again.
So Mike, can we talk about your business a bit? I mean, you're a public markets guy who apparently wandered into a private markets conference. But the evolution of Capital Group over the years to sort of be more to everybody, or at least more to your core client base, that really accelerated over the last year. A partnership with KKR. You finally just rolled out your first two big products in that space. Explain how you're going to run what is effectively a public/private debt vehicle for individual investors.
Thank you, Romaine. The public-private partnership we have with KKR is really exciting. What we're going to do, take 60% public credit that we do today, that we've done for over 50 years in the credit markets, combine it with 40% in private market from KKR, and provide a hybrid solution. What that's going to do, it's going to be cheaper than standalone alternatives, more liquid than standalone alternatives. The low fee, if you look at the fee, it's going to be 84 basis points for one of our strategies, 89 basis points for another. The average interval fund's over 2%. So to create greater accessibility, you need greater liquidity, you need a better fee, and you need a smoother journey. And I think that's what this category will do.
And part of that category too is going down the income spectrum in terms of the clients that would be able to participate in that. A minimum investment of just $1,000?
Yeah, the minimum investment of $1,000, that creates accessibility in itself.
Yeah.
And think about it, if it's 60% public and 40% private, you're going to have greater quarterly liquidity. In most interval funds, you have 5% quarterly liquidity. These strategies will have 10% quarterly liquidity. So that's also important for clients.
In terms of the potential return, is that going to be competitive? And if so, is that competitiveness because of your lower fees or because of the management of the funds?
Fees always matter because clients should think about after fee net returns. So fees are important, but also the expertise of each of us. We're an expert in the public markets. KKR is an expert in the private markets. Combine the two and you're going to have very little interest rate risk of around 4 or 5 years and maybe income of about 8 or 9%. That's a pretty good opportunity for folks in a more liquid vehicle than just a standalone alternative vehicle.
Finally, given that you're talking about the idea of interest rate risk, how much is there out there right now? If you think about the higher for longer that we've been living through and the desire for the president to cut rates, do you think it's possible in this environment where so many people are still worried about inflation?
So I think if you looked at what the market's telling us, you can expect 2 to 3 cuts this year by the Fed later in the year. I think that's probably right. Fed's got to be careful that it can't cut too much with the concern about inflation, as you mentioned. But in a slowing economy, is the Fed going to cut a little bit? I think you'll see that before year end.
What's the really big risk on your mind right now? And not just necessarily specific to Capital Group, but overall.
I think the risks are what everyone's talking about is uncertainty. And investment slows during periods of uncertainty. Every day you get to more certainty, you have more companies who are willing to invest, you have more individual investors and institutions who are willing to invest. So if you're looking to find, well, what's the catalyst for greater corporate investment or individual or institutional investment? It's certainty. So as you get trade deals in the marketplace, as the market volatility comes down, which it's starting to do, I think you'll see greater investment all around.
That is Capital Group CEO Mike Gitlin. We really appreciate your time this morning. Matt? Back to you.
All right, Sonali and Romain, thanks very much. We're going to check back in with you in a bit. Right now, I want to take a look at what's going on in these markets after we got better than expected economic data at the top of the hour. Markets recovered somewhat, still down. The S&P 0.6%, but that's after 9 days consecutive gains. Joining us now to talk more about this is Callie Cox. She is Chief Market Strategist at Ritholtz Wealth Management. And Callie, I want to ask you whether this is the time to get out. I think there were a lot of investors, particularly retail investors, who were shocked at the drops after April 2nd, but didn't have time to react and then sick to their stomachs. And now that they've watched the markets rise for 9 days in a row and we've gained back all that we've lost, is now the time to get out while you can?
Well, I think the answer to that depends on your time frame, of course. But if you're one of those traders that's looking over the next days, or over the next few days, and over the next few weeks, I'd be a little nervous here. It's not the right environment to be a hero. And you have to remember that bear market rallies are a thing, and there's still a lot of legitimate questions about the economy.
So are we in a bear market, though? I mean, if you're worried about the next 3 years, let's say, of decisions coming out of 1600 Pennsylvania Avenue, do you sell stocks now?
I think that depends on the job market. I am encouraged by the strength that we've seen, especially the ISM services number we just got. I'm still worried that, maybe we're in the beginning stages of a recession where we just haven't seen the worst point in the job market or in hiring trends. But it's not here yet. And there's a part of me that thinks that, maybe the economy is resilient enough to make it through. So I'm looking for proof here. The economy has to prove it to me. But if we fall into a recession, it's, looking back at history, it's probably a good guess that we end up falling into a bear market and stocks have to find another center of gravity.
Are there any signs of optimism? I mean, do you expect some sort of stability and certainty at the end of this 90-day pause on tariffs, for example, or are you looking forward to tax cuts and deregulation?
Well, I look at the economy. I'm not a policy analyst. I, of course, want the best outcome for investors and global leaders alike. But, as I look forward to July, I want to understand how companies are looking at these tariffs, what changes they're making to their business operations ahead of the end of this 90-day pause. No, I don't think anybody can give us a real educated answer on what will happen once those 90 days are over. I'm not even sure the administration can say as much. But right now, the best thing you can do as an investor is to watch the job market, watch earnings. Don't try to play policy here because, if you try to do that, you might find yourself wandering into chaos.
Sonali Bassica was talking to Marc Rowan of Apollo last hour, and he was saying basically all roads lead to inflation. The severity of that or the durability of that is in question. But can the Fed really be cutting in that situation?
Well, I'm a little more worried about that. I agree with Marc in that when we first heard about tariffs, there are a lot of questions around the economy and the fact that, or the question that if companies could pass along those costs to consumers. It sounds like companies can. It sounds like companies are taking that first step and seeing how consumers can handle higher prices, which makes me a little more worried about the inflation side. And it sticks the Fed between a rock and a hard place here because both sides of the dual mandate are at risk. What
is the hard data that you're watching out for the most? You mentioned the labor market, and the reading that we had on Friday was good, certainly at a headline level. We didn't get a drop in non-farm payrolls. We didn't get a jump in unemployment. So are you concerned that that comes in the next report or in a few months, as you said, looking forward to July? Well, the job market has been tricky because we know layoffs have been increasing. I mean, we've seen it in the headlines around Doge layoffs. The Challenger Grain Christmas data shows that there have been layoffs in the private sector as well around economic concerns, which is not what you want to see. But we haven't seen that show up as much in hiring, in initial jobless claims, which are technically a leading indicator. I think that goes to show just how resilient the consumer is, which is a good story, especially if you are one of those traders or investors looking over the following days and weeks. I just worry that, we might not know that trend is over until it's over, and by then it's too late. What do you expect in terms of cuts? I see Goldman Sachs doesn't expect to cut until July, but then they think July, September, and October. Do we get 75, 100, 125 basis points of cuts this year? And does that make you more optimistic or more worried?
I'm not sure we get, so I'll start off here. I don't think we get a cut this week. I think the Fed is still in a really tricky spot. I wouldn't be surprised if we saw cuts by the end of the year. You know, I agree with a lot of the banks that are sticking their necks out there and providing forecasts. The thing that I'd warn investors over, though, is that we may not see cuts in good context. We may not see the kind of cuts that we were seeing last year that the Fed was willing to do because it was comfortable with where inflation was. I mean, the Fed cuts for many different reasons, and the context really matters. You know, I think the risk here is that the Fed has to cut. It's backed into a corner where we get some obvious weakness in the job market, and then that side of the dual mandate becomes more clear. If that's the case, then stocks are probably moving lower.
Stocks may be moving lower. We're talking about a bear market. I saw that Tom DeMark, who is a technician that a lot of people, very smart, wealthy people pay close attention to, Paul Tudor Jones, Steve Cohen, Leon Cooperman. What happens in a recession? What should investors be prepared for, or in a bear market? I mean, should they be selling everything and then dollar cost averaging in once we drop 20%, or how does your playbook look?
Well, I think for a recession, the best thing you can do is prepare for one, even though nobody knows when it'll hit you. The problem with a recession is that everybody feels it, right? You know, either you lose your job, God forbid, or, you know, the 60% of Americans who own stocks, a lot of our viewers today feel it in their portfolios. 7 of the last 11 recessions overlapped with bear markets, or the other way around, actually, because recessions cause bear markets. But, you know, it hits you in one way or another. If it's not you, it's your friends and family, and you really have to make sure that you have a plan in place, because you're not sure if your gut feeling can really lead you in the right direction there.
So when do you know if we're in a bear market?
Well, I said a little bit earlier, I think you need to see proof. I think that comes in the form of higher claims. It comes in the form of low to negative payrolls. It comes in the form of job market weakness that we just haven't seen yet. And look, when Americans are making money, they're spending money. Consumer spending is 70% of GDP. That's why you have to look at the consumer first.
All right, Callie, thanks so much for joining us. Callie Cox there of Ritholtz Wealth Management, talking to us about maybe the more dismal scenario. Let's get a look at stocks moving at this hour as we see the indexes falling. Bloomberg's Dentisa Tsekova joins us at the desk. We'll start with a huge winner today, and that is Skechers, which makes what, Uggs?
Yeah, so Skechers is up about 24%. Great day for Skechers. Of course, it's coming off the acquisition news. 3G Capital will take over the company. The price tag is about $9.4 billion. It's likely going to happen in the third quarter of 2025, and it's going to take the company private. What we've seen from Skechers is a lot of pressure because of the tariffs and all the trade uncertainty. A lot of their shoes are actually produced in China and Vietnam, which you can imagine are some of the countries hardest hit by the tariffs. And this is one company that withdrew their full-year outlook based on that. Looking at Tyson Foods, the situation is not so great.
Hang on, I want to just correct myself on Skechers.
It's not
because
good?
it's Deckers.
I wasn't
It's
sure
Deckers.
as well.
It's Deckers.
Okay.
No one's ever actually sure, but no.
Okay.
Deckers makes Uggs. Skechers makes, obviously, Skechers.
Yes, Skechers makes chicken. Okay.
Tyson Foods.
Tyson
chicken.
Foods. Tyson Foods. They make chicken beef. Okay. Tyson Food is down 8% today, as much as 8%. Now it's a little bit more. What we're seeing is that their beef margins are missing estimate. The quarterly result is mixed. There are some good things. For example, chicken has been a really strong thing for them. But what investors are worried is that this might have peaked, and there is a lot of competition in that space. People have boosted production. So despite them wavering that hit from beef, because of course there is a shortage in cattle, the chicken production may be not enough to save the company. The company is down about 2% year to date, which is not so bad, but definitely some more pressure today. And one final look at Netflix. We've been looking at all those media companies heading into the weekend, and obviously things are not looking so great for Netflix. It was down as much as 2%. Some of those losses are reversed. Of course, it's coming on the back of news of President Trump taxing movies that are produced overseas, 100% tariff. But the question here is, are Netflix series that are produced abroad part of it. Obviously, a big part of their business model is things that are produced for global audience. We just had a story on the terminal that, in fact, they're bringing $2 billion of revenue in India just since 2021. So that's a major thing for their revenue, also for Amazon, for Disney, for all those companies. We don't know yet. The company is still up 27%, but investors are definitely worried. It's leading the losses in that sector. Back to you, Matt.
All right, Dentisa, thanks very much. Dentisa Tsekova talking us through, I should say, a couple of the stocks on the move. Skechers does not make Uggs. Those are made by Deckers. And Skechers is the one getting taken private today with a 25% jump in the stock. Coming up, we're going to head back to the Milken Conference in Beverly Hills to hear from Paul Taubman of PJT Partners. This is Bloomberg Open Interest.
And we welcome our television and radio audience. I'm Shonali Basak at the Milken Institute in Beverly Hills, of course, a global conference here. Joining me now, PJT Partners CEO Paul Taubman, who is one of the greatest deal makers of all time. It's fair to say that you've worked on some of the world's largest deals over your career, but you're also quickly building an investment banking firm to have more than 1,000 employees now, I believe, more than 1,100.
Well, first of all, Shonali, thank you very much for having me, and it's great to be here today at Milken.
So you're here at Milken at a time where, of course, everyone is trying to navigate through volatility, as you've been talking to me throughout the commercial break. So how are they doing that? When you talk to your CEO clients around the world, are they on complete hold right now?
No, I don't think that's the case, but the risk premium has clearly gone up. And what that means is everything is still being evaluated, but it's done with a much higher hurdle rate, and you're seeing that everywhere. You're seeing it in credit spreads. Credit spreads have moved out considerably. You're seeing it in PE multiples, where earnings estimates really haven't moved, but the multiples come down because the risk premium is up. And you're seeing it in corporate boardrooms. So transactions continue to happen. We're on pace for the moment for similar transaction volumes to last year globally. The number of transactions is way down. And a lot of deals that otherwise would have been revealed and presented to the market are on hold because we have an environment where it's very difficult to understand where we're going to land in all of this.
Are they on hold, or are those deals dying to some degree? Because if you're a buyer and you're trying to acquire a company and you don't know how their goods are going to be taxed around the world, how do you buy a company without knowing that cost?
Well, first of all, very little has been completely abandoned. Things are just being slow-walked for the moment because every CEO has their to-do list. They have their want-to-haves, they have their must-haves, but it's difficult to land on a transaction and present it to the market in a period of maximum uncertainty. So when we look at our own firm, we're seeing mandates are at record highs, but getting those mandates to announcement, that's what's very difficult for the moment. And every day you're still seeing merger Mondays. You're just seeing merger Mondays with a small m, not a capital M right now.
And a takeover Tuesday here and there. You know, it's interesting. You not only have a massive M&A practice, you have a restructuring practice that's pretty historic, used to be back at Blackstone. What are you seeing now? When you look at the environment, are people looking at severe distress in some industries, or are they on the brink of it?
I think what you're seeing is, look, stress is building in the system. And if you look at the current posture on tariffs, it's really designed to create maximum uncertainty, maximum stress, to get to better aligned trade agreements for the U.S. But while we're in this period, as stress builds and uncertainty builds, you're seeing it with credit spreads. If you just look at beginning of the year till now, credit spreads on the weakest credits are up 180 basis points. That's a sense that stress is building. If you look at where investors want to move to, they want to be in the highest parts of the capital structure. They want to be more senior. They want to be invested in the higher quality, higher rated companies. So we're seeing as active a restructuring market today as we did last year, which was a record. But I see this really as the potential for a step function increase. And that distress is fundamentally in areas that are most affected by this tariff uncertainty, automotive probably being the leading edge of that.
Well, give us a little more color there. To the extent that you might see that step function higher, when? How long can this go on for between those companies dealing with some pain now to what could barrel into much larger pains, even bankruptcies?
Well, I think like anything else, what's the old saying? You know, you go broke slowly and then you go broke quickly. I think right now companies are feeling the stresses and strains. They still don't know what the full tariff regime is. They don't know their ability to move supply chains. They don't know their ability fully to pass on a lot of these costs to the end users. And until a lot of that sorts out, the business models are really in stasis, where the economic model hasn't changed very much, but the risk is meaningfully greater. And what that starts to do is it makes financing significantly more expensive. So the first place you see it, Sonali, is in availability and cost of funding, and that started to tick up appreciably. I think we're still in the early days. Nothing is imminent, but stress is building.
So you also said at the same time that M&A mandates are at a record high. And if you're watching from the sidelines, it's pretty incredible to know that, right? Because you have not seen that flood of deals. What kinds of deals are being talked about right now? Are these massive, transformative deals that will allow companies to take advantage of lower valuations? Or are they actually the other way around? Are they spin-offs to allow people to start to shed some fat at a time where investors are going to be very scrupulous?
So, Sonali, the answer is all of the above, but let's go region, let's go type of transaction. So in Europe, we're quite bullish on Europe. I think the transaction levels in Europe are going to improve appreciably. Part of it is you have in certain industries, highly fragmented industries. You have financials, you have defense, you have communications. Those industries are going to see significantly more consolidation. So those dialogues are active. The next thing is you've seen European valuations disconnect from the U.S., and even though they've outperformed year to date, there's still compelling value there. So take private opportunities, probably more of that in Europe than in the U.S. And then the third is in Europe, you have companies that have significant U.S. presence that want to get inside the trade barriers, inside the tariff barrier, and as a result, there's more desire to come to the U.S. In the U.S., a lot of this is driven by sponsors, and I think we've talked a lot about the fact that the flywheel of monetizations has come to a creeping halt. Every alternative asset manager is trying to create liquidity for their LPs, and they have companies that have held for longer than they typically do, and they're looking for ways to create public IPO alternatives and M&A alternatives. And with the public markets so broken right now, increasingly they're trying to find M&A takeouts.
It's incredible because we've seen that prolonged monetization process for years now. We've been sitting here waiting for private equity firms to sell. Their investors want their money back. I talked to the CEO of Oaktree last week. I asked if the chickens are going to come home to roost. Is this the moment where there could be bigger issues? He's saying he saw some secondary funds being sold for 50 cents on the dollar. That's a pretty incredible number. I'm wondering what you're seeing in terms of pain under the surface.
Well, typically we're seeing every LP is looking in this uncertain environment to reweight, and with the market declines and the lack of monetizations, they're finding that they're overweighted to the alt space. So number one is a lot of these institutions find themselves overweight and they want to reweight. The second is what's going on with universities and the like. They're trying to create more liquidity in their endowments and the like and move out of illiquids into liquids. So what we're seeing is a lot of desire and a lot of portfolios coming to market. The reality is when you're selling a portfolio of blue chip private equity sponsors, there are real discounts, but they're nowhere near the discounts you're suggesting.
Well, so are you saying much of this is a potential flood of selling that's going to come from endowments, given the pressure they're under? Is it almost an idiosyncratic thing going on?
I think what's going on is you need a release valve somewhere, and you can't continue to commit and fund monies to the asset class, without getting a return. And if the IPO markets are very difficult to attack, if it's very difficult to find M&A buyers in this market at premium values, the release valve is increasingly LPs selling portions of their stakes to create liquidity, and GPs trying to do continuation funds to create liquidity.
Now, if I know anything about PJT and you, it's at times of market turnover, tumult, whatever you want to call it, you lean in. Now, when you're talking to a lot of your rivals out there, do you think that this is a market where M&A has slowed down and there might be job cuts? There are going to be people looking to move to places that they're going to capture whatever activity there is. Is it going to get messy out there?
There's always the risk that it gets messy. I think the banks are better capitalized today than they've been in decades. I'm not really worried about systemic issues for the moment. What I do see, though, is with a slowdown in transaction velocity, it's easier for bankers to move from one firm to another. It's most difficult when you have a flood of mandates, and when you go on gardening leave, you're disappointing your client. The friction costs are low right now. We're leaning in. We're trying to take advantage of it. We're going to continue to grow.
We'll keep an eye on that. That is Paul Taubman of PJT Partners. Matt, back to you.
All right, Sonali, thanks very much. Another excellent interview. Paul Taubman there of PJT Capital Partners with Sonali Basak at the Milken Conference in Beverly Hills. We're going to continue to get fantastic coverage out of that conference. As I said earlier, we're going to talk to, or Sonali's going to talk to Jane Fraser of Citi at 1:30 p.m. today in an interview you do not want to miss. Let's take a look at these markets. After a 9-day rally, the longest winning streak that we've seen in 21 years, the market has gotten back for the first time on a closing basis to the April 2nd levels before we got those so-called reciprocal tariffs. Now we're down 0.4% on the S&P 500. President Trump saying that he doesn't plan on talking to Xi Jinping of China this week, but that he does expect a number of deals to materialize. We'll see what kind of deals they are, if they're purchase agreements or if they actually are the kind of trade deals that typically take, as Scott Besson pointed out, a couple of years, 3 years to negotiate. That seems less likely. We do see some really interesting moves across markets outside of equities. You can see that the 10-year yield is up about 4 basis points at 434.53, about 435, right? And you're seeing a real steepening of the curve because we did see the front portion, 2s, 3s, and 5s, actually coming down. Now they're all up, but still the curve is steepening. The dollar continues to weaken, and we're at levels that we haven't seen on the U.S. dollar in over, well, since last September was the last time we saw. So before the elections, last time we saw the Bloomberg dollar index this low. And then NYMEX crude, I think, is the most fascinating. After OPEC Plus on Saturday boosted production again, we see NYMEX crude coming down to below $57 a barrel. Brent crude hovering around $60. That's below the break-even a lot of producers in Texas, according to the Dallas Fed. Treasury Secretary Scott Besson speaks at the Milken Institute Global Conference as well. We're going to bring you his remarks live. This is Bloomberg Open Interest.